All right, let's dive into the world of investing, where slow and steady wins the race. Forget about deciphering stock charts and following short term trends. We're talking about value investing, the approach that stands the test of time. Value investing is the art of finding diamonds in the rough by focusing on a company's intrinsic value rather than short term price movements. Instead of relying on the speculative technical analysis approach, value investors like Warren Buffett dig into a company's fundamentals. So, cash flow, balance sheet, and growth potential. It's about investing in businesses, not playing the market's guessing game. While technical analysis might attract those looking for quick wins, value investing has its own set of advantages. It's a long-term strategy, providing a safety net in case the market is wrong. There can be a lot of market volatility. Warren Buffett, the guru of value investing, often emphasizes that he is allergic to technical analysis, preferring a patient approach that has turned his company, Berkshire Hathaway, into the powerhouse of brands that it is today. So why choose value investing? Because it's not about chasing daily market whims. It's about understanding the businesses you invest in. You won't find true value investors glued to stock charts. That's because they're busy assessing the real worth of a company. In a world obsessed with short-term gains, value investing is the tortoise in the race, steadily accumulating wealth without the need for crystal balls or chart reading skills. So whether you're a seasoned investor or just starting out, consider embracing the power of value investing, where the real treasures lie beneath the surface. Let's debunk a myth in the investing realm, where the terms value and growth often get tossed around like opposing forces. The common fallacy: believing that value and growth investing are separate concepts, when in reality, all investing is fundamentally value investing. So what's the confusion here? Some argue that value investing is all about bargain hunting and beaten down stocks, while growth investing is chasing high-flying companies with robust potential. The truth is, these distinctions are more like shades of the same color. Consider this. A value investor sees a stock trading at $50 but believes its intrinsic value is $80 based on strong fundamentals. That's a pure value play. On the flip side, a so-called growth investor might spot a high potential tech stock at $50, projecting it to reach $100 based on future growth prospects. Still a form of value assessment. The fallacy lies in the perceived divide between the two. Value and growth are not opposing teams. They're teammates in the game of investing. A company showing strong growth potential is, by default, an attractive value proposition. Take Apple as an example. In its early days, it was a growth stock with immense potential. Fast forward, and it's now considered a value stock, boasting stability, dividends, and consistent earnings. So let's shake off the misconception that value and growth are locked in some eternal rivalry. In the world of investing, they're intertwined threads. After all, every investment, whether a seemingly undervalued or a high growth company, boils down to assessing its intrinsic value. It's time to embrace the harmony between growth and value investing. All right, let's explain the jargon and talk about investing versus speculation. At their core, both activities involve risking your hard-earned cash in the hopes of making a profit. Whether you're investing or speculating, you're essentially putting your money where your crystal ball is. It's a gamble, a dance with uncertainty. Both endeavors require some level of analysis, be it diving into a company's fundamentals for investment or trying to predict short-term market moves. Now here's where it gets interesting. The boundary between the two is fuzzy. What might start as an investment can quickly turn into speculation if driven by short-term market whims or a focus on price rather than a solid understanding of a company's worth. Consider this: buying a stock because you believe in its long-term potential and growth prospects based on a careful analysis, that is investing. On the other hand, snatching it up because you heard a hot tip from a neighbor and hope to sell it for a quick profit, well, that's speculation. The key takeaway: it's not a black and white world, and both involve an element of risk. And success often depends on a mix of analysis, timing, and a dash of luck. So the next time you're eyeing the stock market, ask yourself, are you investing or are you speculating? And the line might actually be thinner than you think. Let's demystify the dance between gambling and investing. They're like distant cousins with a few key distinctions. Imagine strolling into a casino. Patrons placing their bets are just like investors, right? Wrong. They are gamblers. The real investor in this scenario is what? The house. Why? Because the house has a predefined edge, a calculated advantage that keeps the odds where? In its favor. Now, let's compare this to the world of investing. When you buy a stock, it's not a gamble if you've identified an edge. Take value investing, for example. You're not rolling the dice and hoping for the best. You're carefully analyzing a company's fundamentals, looking for a margin of safety, and seeking businesses trading below their intrinsic value. The difference lies in the approach. Gamblers often rely on luck, chance, and fleeting emotions, while investors, particularly value investors, focus on information, analysis, and a rational strategy. It's not about blind bets. It's about understanding the game. In both cases, the element of risk remains, but the distinction emerges in how you navigate it. A gamble becomes an investment when you've identified that crucial edge, much like the house in the casino. Would you rather be the house or the gambler? So the next time you're tempted to roll the dice with your money, think like the house. Seek your edge and play the long game.